Welcome to the New Alpha Studio, AI virtual studio, obviously. Today, we're going to be talking about something that I think most people should know, but very few do. And that really is the question for me that I always ask before I start looking at the returns on any type of strategy. It's a basic due diligence question that is consistently overlooked in place of looking at really the misleading data. And in this short video, I want to cover really one of the really important questions that you should be asking when conducting due diligence on a trading strategy. So this is the question I ask before I even look at returns. And in today's market, glossy fact sheets have become the norm. Generally seeing smooth equity curves, 10 to 20% per month growth, high win rates, long holding times. It all looks impressive until you ask a few basic due diligence questions. More often than not, that consistent growth is purely down to balance growth, not true equity performance. Under the surface, the strategy is carrying persistent floating risk, sometimes 10%, 20%, even 30 to 50% open drawdown, only closing positions once the market has eventually turned in its favor, meaning those losing positions are held until the market turns and turns them positive. Only then do they get closed. That's misleading. That's dangerous. Carrying risk until the market corrects is a fool's game. That's not risk management. That's called risk deferral. Let's be clear about the maths. A 30% drawdown on equity requires a 43% growth to recover. A 50% drawdown requires 100% growth to recover. If a strategy is making 10 to 20% a month and a single deep event occurs, that can mean it could take easily a year or more to get back even to break even. And that's assuming a perfectly clean run, if indeed that's possible. A clean run for a year plus some without another single drawdown. If it happens twice, it's game over 100%. And in trading, given enough time, it will happen. So before I even look at the dressed up performance report, I ask one simple question. What's your deepest valley and how long did it take to recover? That's all you need to ask. What's your deepest valley and how long did it take to recover? It's a peak to trough decline. Time underwater. A path back to a new equity high. This matters because the real risk in any strategy isn't the average month. It's the extreme period. The 2008 moment, the COVID shock, the regime shift when correlations break and liquidity disappears. We saw it in January of this year. Extreme hyper volatility where traders were bleeding and nobody knew how to trade it. And the fools that still kept trading it were certain to lose. Those are the periods that destroy capital. Yet most managers either can't answer the question, won't answer the question, or have never measured it properly. Now that tells you everything you need to know. With volatility elevated and regimes changing faster than ever, the only predictable thing in markets is the unpredictable. Unfortunately, too many managers and even more white label marketers are still selling upside and smooth curves, playing to investors' greed instead of focusing on what actually matters: survivability, capital protection, and consistency through stress. In my next post, I'll be sharing with you what sensible risk framework actually looks like on one of our strategies and why we prioritize resilience over glossy short-term returns. I hope you found this interesting, and I hope you use this moving forward. Again, my name's Caesar. Welcome to the New Alpha virtual studio. Take care now.